Privatized Gains, Socialized Risk, How 5 Industrial Pillars Became Too Critical to Fail. Section 1, Introduction. The modern American political economic architecture is frequently understood through the lens of traditional market competition and democratic governance. Over the past several decades, however, a structural mutation has occurred beneath the surface of the state market nexus. The system is no longer driven primarily by open market forces, but by an asymmetric bargain anchored in a single, recurring invariant. Private upside plus public tail risk guarantee equals structural moral hazard. When private entities grow to occupy systemically indispensable nodes of society, their scale and operational interconnectedness render their failure socially and politically intolerable. Consequently, an unwritten structural guarantee emerges. Private actors capture astronomical commercial returns during periods of expansion, but whenever systemic risks materialize into catastrophic losses, those burdens migrate directly onto the sovereign balance sheet. Rather than functioning as a monolith of raw corruption, this architecture operates through 5 system-critical private sectors that control the fundamental infrastructural functions of modern civilization: health, information, money and credit, security, and capital allocation. Because the state cannot permit these nodes to collapse without risking total societal failure, it has been systematically transformed from a traditional democratic regulator into the ultimate guarantor of systemic continuity. This dynamic does not merely resolve recurrent crises, it institutionalizes moral hazard and locks the global system into an era of state-underwritten instability. 2. The theoretical engine: systemic indispensability and moral hazard. To comprehend how the American economic engine generates perpetual crisis, one must abandon the naive view that state intervention occurs only during unexpected exogenous shocks. Instead, intervention is the predictable output of a system designed around indispensability. In classical economic theory, risk and reward are meant to travel together. Those who reap the profits of an enterprise must bear the full weight of its failures. The architecture of modern American capitalism short-circuits this feedback loop through a distinct multi-stage mechanism. 1. Private profit and concentration. Capitalist enterprises consolidate within systemically critical sectors, accumulating vast private rewards and market power. 2. Systemic indispensability. Through vertical integration, network effects, or financial leverage, these entities become so deeply woven into the fabric of daily life that their sudden disappearance would freeze the economy, paralyze national security, or collapse public health. 3. The bailout threshold. When reckless risk-taking, operational hubris, or macroeconomic shifts threaten these entities with insolvency, the threat of contagion makes disorderly failure politically impossible. 4. Sovereign risk migration. The state steps in, injecting liquidity, guaranteeing debt, absorbing liabilities, or underwriting foundational research, effectively nationalizing the downside while leaving private upside intact. This feedback loop alters the behavior of corporate leadership. Knowing that a sufficiently large failure will trigger a public rescue operation, private entities are incentivized to maximize short-term extraction and leverage, secure in the knowledge that the ultimate risk is absorbed by the taxpayer. The state, trapped by its own reliance on these infrastructural nodes, evolves from a neutral umpire into a perpetual backstop. Section 3, the 5 system critical pillars. 1. Big finance. The architecture of contagion and liquidity backstops. Big finance represents the historical template for the socialization of risk. Operating at the core of money creation, credit intermediation, and asset valuation, the modern banking sector relies entirely on systemic interconnectedness to enforce its safety net. The mechanism was laid bare during the 2008 global financial crisis. Decades of aggressive deregulation, shadow banking expansion, and the packaging of fraudulent subprime mortgages generated immense private bonuses and fee income. When the housing market collapsed, the toxicity of these assets threatened to freeze global commerce. The state was forced to intervene through unprecedented measures, including the Troubled Asset Relief Program, TARP, which authorized hundreds of billions in emergency injections to stabilize institutions like Citigroup, Bank of America, and American International Group, AIG. While proponents argued that subsequent loan repayments minimized direct accounting losses, The true socialization of risk went far beyond ledger math. The Federal Reserve and the Treasury backstopped trillions of dollars in commercial paper, guaranteed interbank lending, and rescued money market funds. Private institutions retained the preceding decade of boom time profits, while the sovereign absorbed the structural shock of financial near-death. 2. Big Pharma, public R&D subsidization and emergency procurement. The pharmaceutical sector manages human biological vulnerability, operating through an asymmetric model where basic scientific discovery is largely socialized, while commercial rewards are aggressively privatized. The structural mechanics of this pillar rely on public-backed research funding channeled through institutions like the National Institutes of Health, NIH, which underwrite the high-risk, expensive foundational science required to bring novel therapeutics to life. When global emergencies strike, such as the COVID-19 pandemic, the state drops all pretense of free market distance. Under initiatives like Operation Warp Speed, the U.S. government injected over $18 billion in direct public funding into private pharmaceutical firms to accelerate clinical trials and manufacturing scaling. Moderna, for example, received nearly $1 billion for R&D, alongside multi-billion-dollar advanced procurement guarantees. In this arrangement, taxpayers fund the R&D risk and guarantee the baseline market demand, yet private pharmaceutical corporations retain exclusive intellectual property rights, exercise unchecked pricing power, and post record-shattering corporate revenues. The public absorbs the biological and financial exposure of health crises, while corporate balance sheets capture the windfall. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. 3. Private capital and shadow banking. The trillion-dollar leverage loop. While traditional commercial banks face stringent regulatory oversight following 2008, a massive shadow banking ecosystem has evolved to bypass these guardrails. Spanning private equity, private credit, and non-bank financial intermediaries, private capital has emerged as a dominant force in corporate ownership and lending. With global assets under management in private credit alone climbing past the $2 trillion mark and scaling toward multi-trillion-dollar projections, this sector operates largely in the dark. Private equity firms routinely acquire vital corporate, healthcare, and housing infrastructure, load those entities with immense debt structures, extract management fees, and shift operational risks downward. Meanwhile, private credit funds step in to provide direct corporate lending outside traditional regulatory transparency. Because these credit markets are deeply intertwined with institutional pensions, insurance funds, and corporate balance sheets, any widespread default cycle risks triggering systemic contagion. This sets the stage for the next great bailout, a shadow banking freeze that will inevitably demand central bank intervention to prevent the collapse of non-bank financial plumbing. 4. The military-industrial complex, inseparable state-industrial dependency. Unlike sectors where the state steps in only after a private market failure, the military-industrial complex operates within a state-created market where the government is simultaneously the sole customer, the financier of production infrastructure, and the guarantor of long-term demand. Decades of corporate consolidation have left the defense industrial base concentrated among a handful of prime contractors, such as Lockheed Martin, RTX Corporation, Boeing, General Dynamics, and Northrop Grumman. These entities absorb hundreds of billions in annual Pentagon outlays under multi-year, no-bid contracts. However, the systemic vulnerability of this pillar manifests as industrial hollow-out. Driven by financial engineering, such as massive stock buybacks designed to boost share prices rather than investing in physical factory capacity or munitions supply chains, the defense sector struggles significantly when geopolitical strain requires surge production across multiple global theaters. The state is forced to inject additional billions directly into industrial base revitalization, absorbing the capital expenditure risks of a private sector optimized for financial extraction rather than national resilience. 5. Big tech, infrastructural dominance, and state-sanctioned moats. Big tech occupies the information and communication nodes of modern civilization. comprising conglomerates whose cash reserves rival sovereign GDPs, technology giants control cloud computing infrastructure, digital payment channels, and global information flows. While big tech rarely requires direct financial bailouts from the Treasury, its risk socialization operates through infrastructural dependence and legal insulation. These corporations rely on state-enforced intellectual property monopolies, sweeping liability protections, such as Section 230, and deep integration with state intelligence and defense apparatuses through massive cloud computing contracts. The asymmetry here is societal and democratic. Big tech privatizes the immense commercial rewards of the digital attention economy, while externalizing the severe psychological, civic, and democratic degradation associated with monopolized information networks onto the public sphere. When antitrust regulators finally challenge these behemoths, the legal battles span decades, insulating their core infrastructure while public institutions grapple with the societal fallout of attention economy decay. Section 4. Conclusion. The cross-examination of America's dominant private pillars reveals a unifying systemic truth. The recurring crises shaking the global economy are not anomalies or accidental failures of policy. They are the predictable consequences of an economic model built on privatized gains and socialized risk. By outsourcing system-critical functions, money, health, security, information, and capital allocation, to private entities whose primary operational logic is short-term rent extraction, the state has manufactured a continuous state of emergency. When these entities become too critical to fail, systemic importance converts private risk into public exposure. Without structural reciprocity, strict public compensation, or genuine accountability for underwriting tail risk, the American state remains trapped in a reactive loop. It is condemned to act perpetually as the guarantor of last resort, bailing out balance sheets, subsidizing failures, and presiding over an institutional exhaustion that threatens the stability of the entire global order.